Hello friends, welcome back to the Brilliancy Point. I hope you all are doing well and enjoying your great wealth accounts. So in today's video, as you can see on your screen, we are going to learn cash flow statement. So it is a very interesting topics and it is one of my favorite topics. And let me tell you what all we are going to cover in this video. So in this video, I will explain you the entire detailed format of cash flow statement. Okay, I'll tell you the treatment of each and every item. That why do we treat certain items in a certain way in cash flow statement and how exactly we prepare it. I will give you each and every detail and towards the end we will also discuss how to prepare the working notes. Okay, I will also tell you how you should prepare your working notes and I will tell you the treatment of each and every item. And trust me, if you watch this video till the end, you can solve any question on cash flow statement and you will definitely understand everything in one go. So let us start. I'll give you a very brief introduction of what is cash flow statement. So as the name suggests, cash flow statement tells us about the inflow and outflow of cash and cash equivalents, right? So what are cash equivalents? Okay. Cash to we understand. Cash means cash in hand, which we carry in the form of notes or currency, and it also includes cash with the bank, our deposits with the bank. Now, what are cash equivalents? Cash equivalents means all those things or all those assets of the firm which can readily be converted into cash as and when one desires. So that is why they are called cash equivalent. Means we can convert them into cash whenever we want. So what are the items included in cash equivalents? So the very first item is marketable securities, or we can term it as short-term investments. Yeah. So what are short-term investments? Short-term investments means those investments which have a maturity period of less than 3 months. Means we can sell them within 3 months and they don't carry any significant risk of change in value. Yeah, means we cannot expect that there can be a fall in the value. Means we in short term investments we don't include shares and bonds and all these things because shares prices may fluctuate, right? And bonds, they are not for short term, they are for long term. So in short term investments we can consider such types of investments which do not carry any risk of change in value and which can be converted within cash within 3 months. Yeah, that is why we call them as equivalent to cash. And marketable securities are also the same. And then we also include deposits with the bank. Yeah, all sorts of deposits, whether it is fixed deposit or any other sort of deposit, because whenever we ask the bank, we can get our money back in the form of cash and we can use it, right? So this is the basic idea of cash and cash equivalents, and the purpose of cash flow statement is to find the balance of cash, the opening balance, how much it was, and at the end of the year how much closing balance we are having, so as to find that what was the net flow of cash, yeah, throughout the year. And we classify this flow of cash into three categories, that is called operating activities, investing activities, and financing activities. Now, why do we do this? We do this in order to kind of analyze, because cash flow statement is a tool for analysis. Yeah, it forms a part of analysis tool. So it is one of the tools for analyzing the position of business, right? So for analyzing, we need to categorize the things, we need to sort the things so that we can understand that where is the cash being used, where from are we getting the flow of cash. Okay, so for this convenience, we prepare cash flow statement in three divisions, we can say. First is cash flow from operating activities, then investing, and then financing. So with this, let us now move towards the format of cash flow statement. So we begin with cash flow from operating activities. Now, what is the very first step in finding out cash flow from operating activities? So before this, let us understand that what are operating activities. You all might be knowing that operating activities are those activities which are the principal revenue producing activities for the firm. Now, what do we mean by principal revenue producing activities? So let's say you have a tea manufacturing company. So what is the source of revenue for your company? It will be by selling tea, right? So all the activities related to that tea manufacturing, all those activities will count under operating activities, whether it is the purchase of materials, whether it is the manufacturing process. So all the expenses related to that manufacturing, and then all the steps taken to distribute that tea, right, to get it to the customers, to take it to the customers. So all the activities involved, right from the purchase till it reaches the customer. So all the activities associated with this thing, it will be counted under operating activities for the company, for the organization. Yeah. Now, if you look at the format, you might be a little confused that why are we adding or subtracting certain items, okay, under the cash flow from operating activities. So this is because we are following the indirect method. Please pay attention on this, that we are following the indirect method, which means that we are not directly adding up the operating activities, because as I told you that operating activities includes all the activities relating to the business in which the firm is engaged, right? So there would be n number of operating activities, there would be a very huge number of operating activities for any firm, and therefore it is not convenient to add each and every operating activity and then find that what was the net flow from operating activities. I hope you get this point, and that is why we are following the indirect method. Now, indirect method means what? It means that we take the profit from the P&L account, from the statement of P&L. We take the profit and then we remove the unwanted items from it, right? Which means that we remove all the non-operating items from that balance, or the balance in the statement of P&L. Okay, so from the net profit, we remove all the non-operating items, and then what is left is obviously the cash flow from operating activities. So this is basically what we are going to do. Now, why do we take net profit? So it is also quite obvious. If you remember, in your grade 11th, you had studied that we prepare trading account and then P&L account. You would have studied that. But in companies, we only prepare one statement, which is called statement of P&L. And we transfer all the items, each and every transaction that took during the year for company's business. Yeah, all the business related transactions, they are transferred to the statement of P&L at the end of the year, right? Which means that P&L account, it takes the effect of all the transactions, of all the activities. Yeah, so all the activities are already included in P&L account. The effect is already included, and that is why the balance that we get, that is the net profit or maybe net loss. So that balance, it is the after effect, or we can say it is a culmination of all the transactions. It includes the effect of all the transactions. That is why we take that net profit from P&L account, and then we remove the non-operating items. So what we get as balance is the flow from operating activities, right? So this is the entire logic behind what we are doing. Now it will be very easy for you to just memorize or understand the specific items that we add or subtract. So what is the first step for preparing cash flow from operating activities? So we'll have to follow a little procedure for finding this net profit or the balance that we get in the statement of P&L. So for finding that also we'll have to follow a very little procedure. And this is because we are not given with the information directly. Okay, you won't be given in the question that the profit for this year or the net profit, or things like the balance in the statement of P&L account was this much. You won't be given information like this. What you will be given with is, you will either be given with a balance sheet or you will be given with a trial balance, yeah, which will contain the balances of different accounts. So you will have to add certain items so as to get the net profit. Why? Listen, if you are given with balance sheet, so what all will you be given with? Shareholders funds, right? And within that shareholders funds you will be given with reserves and surplus. And surplus, what do we mean by surplus? Surplus means the excess profit which is left with the company after doing all the transactions, after distributing it to each and every stakeholder, like after paying off the liabilities, after paying the dividends to the shareholders, after distributing it, whatever excess you are left with, that is called surplus, right? And that is what we show in balance sheet. Now this surplus is not equal to net profit. Why? Because in net profit, we get net profit in statement of P&L, right? And after getting that net profit, from that net profit we pay our tax, okay, and we pay dividend after getting that net profit, right? Means the effect of dividend is not included in that P&L account, or it is not included in the net profit, but in surplus the effect of dividend is included. So we need to remove that effect of dividend from the surplus in order to get net profit. I hope you got this point. So like this, there are basically three items which we need to remove from surplus so as to derive, or so as to go to the net profit. So what are these items? First, as I told you, it's dividend. Now any kind of dividend. It can be interim dividend paid on equity shares. It can be preference dividend, or if nothing is given and you are given with proposed dividend. So we consider that proposed dividend for previous year is being paid in this year, because the final dividend, okay, for the year, it is proposed at the end of at the end of a financial year, and then it is paid in the next accounting year. So that is why we consider the proposed dividend of previous year. So you need to add proposed dividend of previous year. Then we also need to add the provision for tax made during the year. Now, why do we add provision for tax made during the year? We add it because it is a non-cash expense, right? See, we are preparing cash flow statement, right? So you also need to remove, or you need to kind of do away with the effect of non-cash items, because we are preparing cash flow statement, okay? Now, what are provisions? Provisions means we are setting aside, or we are kind of treating it as an expense. Provision means we are creating a reserve for meeting an expense in the future, because we know that this expense will definitely arise. So let us create a provision. Let us set aside a certain amount so that we cannot use it in some other purpose. So we show it as an expense. Yeah, and that is what we call provision. So provision for tax is not the actual tax that we have paid, right? It is not the actual tax that we have paid. It is just that we are showing a provision, we are showing a reserve that this amount should be reserved for paying the tax. But it is not an actual outflow or inflow of cash. Okay, so that is, and if you remember, we prepare a statement of P&L on accrual basis, right? On accrual basis, which means that whether we are paying an expense in cash or not, we record it as soon as we incur it, okay? So that is why we need to remove the non-cash items, because statement of P&L, it includes non-cash items as well, right? So we need to remove it, and that is why we will add back the provision made for tax, so that because it is not an outflow of cash, but we unnecessarily it was taken into account while getting at the profit, so we need to add it back so as to remove its effect, okay? So these two items, and then what else do we need to add? We also need to add general reserve, or any sort of reserve. Not exactly any sort of reserve, only general reserve or debenture redemption reserve. If these two reserves are given in the question, I mean the balances are given, so you will have to see that how much is the increase from previous year, how much has the general reserve or debenture redemption reserve has increased, and you need to add that difference amount, okay? Now, if you are given with securities premium reserve, will you add it? The answer is no. Why? Because we don't transfer our profit into securities premium reserve. What do we transfer into securities premium reserve? We add the premium which we get on issue of shares or debentures. We add that premium into that reserve, right? So we are not transferring our profit into that reserve, right? But what do we do in general reserve or DRR? We transfer a part of our profit into that reserve, and therefore after we get the net profit from the statement of P&L, then we transfer a part of the profit to the reserve, either general reserve or debenture redemption reserve. Yeah, and that is why to find net profit from the surplus, we need to add the amount that we transferred to the general reserve or DRR. So we add back that amount also. So I'll show you how exactly this is done. See. So according to the information you are given in the question, what all out of dividend, provision for tax made during the year, and transfer to general reserve or DRR. So you need to add it all to get net profit before tax. And when you get this net profit before tax, you have to write it in this cash flow statement, right? Uh, Finding out NPBT, it's a part of working note. And then you will find it out and then you'll write it here, as you can see. You'll write it here. And then after finding the NPBT, what will we do? We will remove those items which were debited or credited to our statement of P&L, but they were non-operating or they were non-cash, right? For example, depreciation. It's a non-cash expense. We don't pay it in cash, so we will add it back. Then amortization of intangible assets, we'll add it back. Similarly, interest on borrowings and debentures. Now, interest on borrowings and debentures, it is a cash expense, but it is non-operating because it is finance cost. So it will go under financing activity, right? So we will remove its effect from the operating activities, and that is why we are adding it back to the NPBT, because it is also debited into statement of P&L, which means that our net profit, it was reduced because of this expenditure, but we didn't want it to reduce because it is not an expense, it is not an operating expense, so we are adding it back. Similarly, all the finance expenses, discount on issue of debentures, underwriting commission, premium on redemption of debentures, sorry, premium on redemption of debentures, and all these finance items, finance cost, they are added back. Then the next thing which is added back is loss on sale of fixed asset. Okay, like I said, you are having a tea manufacturing company. So you might be having some fixed assets in your business like machinery and all these things. Now what if your machine becomes obsolete and you are selling it? It's not a part of your operations, right? Your business concern is about selling tea, and it was occasionally, it was an occasional thing that you sold a machinery. So loss or profit on that, it is not your operating income, right? But even the loss or profit on sale of machinery or anything, we debit it or credit it to P&L account. That is why we'll remove that also. So we'll add the loss on sale of fixed asset, right? And we will also add increase in provision for doubtful debts, because again it's a provision, which means that it's a non-cash expense. It was just that we created a provision, we showed it as an expense, but it wasn't paid in cash. So if provision for doubtful debts is increasing, it means that we are debiting more amount to provision for doubtful debts, right? But it should not have been done because it is a non-cash expense, so we will add it. Similarly, what all should we deduct from NPBT? Interest, dividend, rent received, and profit on sale of fixed asset, and decrease in provision for doubtful debt, which means that if the provision for doubtful debt for previous year it was more, but for this year it is less, so we subtract it, because it means that some part of this provision for doubtful debt, it was reversed, right? Which is a gain for us, but it is again a non-cash gain, non-cash income. So we'll subtract it. And when we do all this, so whatever balance we get in the outer column after adding and subtracting all these items to NPBT, what we get is known as operating profit before working capital changes. Right. Now, working capital changes. You all must know what is working capital. Working capital means it is the difference between current assets and current liabilities. Means it is the amount of capital which is invested into the business for day-to-day operations. That is called working capital. Now, why do we consider working capital changes? Try to understand it. Let's take example of a current asset, that is trade receivable. Okay, now what are trade receivables? Trade receivable means all those bills and all that amount which is receivable from our debtors, right? Which means that if you sold some goods on credit and that person didn't pay you in cash at that time, right, and he says that I'll pay you later, then that becomes trade receivable for you, right? What does that mean? It means that you are not getting cash at this point of time. Yeah, you are not getting any inflow of cash. You will get it later because it is receivable for you. So if your trade receivables are increasing, like previous year your trade receivables were less but this year they are more, it means that more of your money is being blocked because you are purchasing item from somewhere, right, and you are paying them, but you are not getting the cash from your buyers. You will get it afterwards, which means that the cash is not coming in but it is going out, right? So that is why if there is an increase in current asset, then you will subtract it. Okay, so increase in current assets are subtracted, and opposite way, decrease in current assets, they are added. Similarly, for current liabilities, it's the opposite way around. Increase in current liabilities are added. So in this way, we treat current assets and current liabilities. Okay, I'll tell you once more. Decrease in current assets and increase in current liabilities, they are added. And increase in current assets and decrease in current liabilities are subtracted. And I hope the logic is very clear to you. Now, when you add and subtract these changes in working capital, then whatever you get, that is called cash generated from operations, right? And after that, you subtract the income tax which you actually paid. Okay, the tax that you actually paid, that will result in outflow of cash, and that is why you subtract it, because the cash is going out. So you subtract it, and then finally what you get is called cash flow from operating activities. Now, before moving on to cash flow from investing activities, there is one more thing, that you won't be directly given with the information like income tax paid was itna, or income tax like provision for income tax provided during the year or created during the year, it was this much. You won't directly be given with this information. As I told you, what you will be given with is, let's say you will be given with a balance sheet. In balance sheet, you will be given with the closing balances, right, that we transfer at the end of the year. So you will be given the closing balances for 2 years. Let's say for the year ended 31st March 2021 and 2022. So you will be given with the opening and closing balance, right? So you will have to prepare a provision for tax account like this. I'll show you. So provision for tax, it has a credit balance because it's a provision. Remember that all the provisions have a credit balance. So that is why we will write by balance BD on the credit side, that is the balance brought down, and we will write to balance carried down, which will be the closing balance. Okay. So in balance brought down, you will write the opening balance, that is the balance you will be given for previous year, and in balance carried down you will write the balance for this year, current year, that is the closing balance. And then you will be given with either of the two information in the adjustments. Okay, you will be either given with this adjustment, that tax paid during the year, was blah blah blah. So what will be the entry for paying tax? The entry for paying tax will be, since cash is going out, so the entry should be provision for tax account debit to cash or bank account. So it will come on the debit side, as you can see, to bank account, and you will write the amount of tax paid. And then you will get a balancing figure on the credit side. Okay, you will when you try to total both the columns, you will get a difference on credit side, and that would be by statement of P&L. Means it is the amount of provision that we created during the year. And this amount 9,000, which you can see here, so this provision for tax created during the year, it is added for calculating NPBT, what I told you in the very beginning, where we add dividend, okay, where we find the surplus, and then into the surplus we add dividend and this provision for tax made during the year, and transfer to general reserve and these things. So there you will add this amount, and this tax paid, you will subtract it right now, as I told you, before finding the final cash flow from operating activities. So here you will subtract that amount of tax actually paid. Now you can be given with either of the information. Maybe you are given with the opening and closing balance. This too you will be given for sure, opening and closing balance. And maybe you are given with the provision for tax made during the year. So you will get the balancing figure on the debit side, and that would be the tax paid. So you will have to find the balancing figure. I mean, one of the things you will have to find out by preparing this account. Okay, now one more thing can happen, that maybe you are given with just two things, the opening and the closing balance, which will be shown in the balance sheet. Right. See, if you are given with three things, if you are given with three items or three information, then you have to prepare the account and you have to find the fourth item, the fourth piece of information, right? But if you are given with only two pieces of information, then you don't need to prepare an account. You just need to go by the convention. Now, what does the convention say? The previous year provision for tax, okay, means the opening balance for this year, the opening balance for the current year, or the previous year's closing balance of provision for tax, it is considered as the tax paid. Okay, so that will be lessened here. Okay, and the current year's closing balance for provision for tax, it will be considered as the provision for tax made during the year, so it will be added for calculating NPBT. Okay, so this is the normal convention. And with this, we are 100% done with cash flow from operating activities. I hope it is very clear to you, and if you keep all these points in mind, I'm very sure you will be able to tackle each and every question. Here we come to the end of the first part of this video, and in the next part I'll explain you cash flow from investing and financing activities. So till then, take care, bye bye. And if you have not yet subscribed to our channel, please subscribe our channel for more interesting and helpful videos.